Hi, this is Kirubakaran Rajendran. Welcome to Trading with Groww channel. In this video, we're going to talk about how do you manage order execution and risk management specifically with respect to options trading. So in this video, we're going to address 6 important factors. So the first thing is understanding stop loss jumps and what are the strategies that you can implement to prevent them. And the next thing is what are the techniques that you need to follow in order to find the optimal entry prices with respect to your options trading. And the third thing is what are the effective stop loss mechanisms. So when you use stop loss limit orders, what are the mechanisms that you should implement that would really help you. And the fourth thing is steps that you need to take whenever you experience sudden stop loss jumps. Say suppose you have placed an order and no, instead of stop loss getting filled, the stop loss did not fill and it suddenly jumps and the market is trading way above your stop loss price. So in that case, how do you manage it? And the fifth thing is what are the guidelines that you need to follow when you are executing large number of orders. Say suppose if you are executing more than the freeze quantity, how do you handle it? And the last thing is what are the best practices for placing orders in volatile market conditions. So when the market is extremely volatile, what are the best practices that you need to follow? So these are the things which we are going to address in detail in this video. So first thing is we'll understand what stop loss jump means. See, the current chart that you are seeing is 22,400 call option strike for Nifty. Say suppose no, we have shorted this specific strike somewhere around this level. Okay, so you have shorted around 85 levels and you have kept the stop loss around 95. So you have kept 10 rupees as stop loss. So now if you see what happens is when the market moved, it started moving up here, and in this candle if you see it suddenly started moving up wildly, which means that say suppose if you have kept the stop loss as 95, but if your stop loss is not filled here, then what happens? The market starts moving up and then your whatever the position which you have shorted at 85 will still be open around this level. So in this case what would happen is you will end up in a much higher loss. You were anticipating a 10 rupees loss by shorting at 85 and trying to cover at 95. But in case if the stop loss is not filled here, you end up covering at somewhere around 100 rupees or 105 rupees. And the worst part is in case if you are stuck in some office job and you did not monitor at all, and if the market starts climbing up and up and up, then you will be ending up in a much higher loss. So when you keep a stop loss at this level and if that level is not filled, then what are the things that you need to follow? So with respect to handling the stop loss jumps, the other ideal way that you can implement is adding a hedge strike. Say suppose with respect to 22,400 call option which we have shorted around this 85 rupees and trying to keep a stop loss at 95 rupees, where in case if 95 rupees stop loss is not filled, then we are trying to exit probably around this 105 rupees. So we are skipping a stop loss and then exiting with the 10 rupees slippages, right? So how do you handle it is by the time you enter this strike of 22,400 call option, you have shorted it, you try to buy a strike which is to 100 points away OTM options, which is 22,500 call options. So I short around 84 rupees with respect to this strike, and the next two strikes away I'll try to buy it. So when I try to enter itself, when I'm buying this hedge, my complete loss is protected. So even if I don't monitor the positions by end of the day, I know my risk is capped. So when I enter around 85 rupees at this time, the same strike 22,500, I'll enter around 35 rupees. Now what happens? We are trying to cover the position around, say suppose we are trying to cover the position around this peak of around 105 rupees. Since 95, our stop loss was jumped and we are trying to exit here. Now what happens is this 10 rupees slippages will be covered here around 50 rupees. So what happens? So you buy a strike around 35 rupees and you exit around 50 rupees. So this 15 rupees profit which you make in hedge, which is totally compensated with the loss that you face with respect to slippages. So basically when you try to enter and the stop loss jumps, if you have a hedge positions, you are protected. So coming to the optimal entry points. So what are the techniques that you can follow with respect to finding the optimal entry points? So most of the option sellers, what they do is they try to enter into the markets as soon as the market is opened. So instead of that, you wait for some action to happen and then follow the trend. Say for an example, this chart, what you're seeing currently is Nifty 50 underlying chart. So what I would do is, instead of entering a short straddle or short strangle as an option seller in the morning itself, I'll try to wait for the index to form a range. Say for an example, today's range is, this is the overall range where the market was tight in a tight range from around 9:15 till 9:45. But after 9:45, it started breaking the range and started moving up. So what I can do is, instead of creating a short straddle or short triangle, I can just wait and observe where the market is going. If this range is broken, the first 30 minutes range is broken on the upside or on the downside, I'll monitor. If it is broken on the upside, I'll just short a put option. If it is broken on the downside, I'll just short a call option. So this way, you can identify the trend and enter into the market. So if you have just entered into a short straddle or short triangle in the morning itself, you would have ended up in a loss because market started rallying. So by observing the market's movement at least for first 30 minutes and then initiating a trade will give you a clear idea. So in this case, what would I do is, I'll just wait here since the range is broken out here. So what I can do is, I can short a put option here. So I can short a put option of 22,400 put option. So as the market was moving up, that put option will give you a good profits. So this is the 24,400 put option strike. So if you see, even this has given a good range. So this was the high range and then this was the lower range, right? So approximately market started giving you this range breakout around this level. So what happens is, around 61 rupees I would have shorted it. Now market is around, the same strike is trading around 40 rupees. So 20 rupees I would have made profits with respect to just one trade. So what I can do is, I can keep a simple stop loss. So check whichever specific candle is broken and keep that specific candle high as stop loss. So I have shorted at 61 rupees. My stop loss is 64 rupees. Just 4 or 5 rupees is my overall stop loss. But what happens once the trend was broken, it started going down, going down, going down, and that has given you a good profit. So you don't need to directly take a short straddle or short strangle. Instead, wait for the market movements and observe how the market is moving, and based on the trend, initiate a directional trade where you can short call option or short put option and observe which candle is it's breaking and keep that candle's high as a stop loss. So in this trade, by entering at 60 and by trading currently at 40 rupees, I almost make 20 rupees profit in just less than 1 hour with a very minimal risk where the reward is so huge. So this is how you can find out the entry techniques and apply these techniques with respect to your options trading. So now we'll see effective stop loss settings. Say suppose you wanted to short a specific strike. Say suppose we are currently this specific strike is trading around 65 rupees, right? So we wanted to say suppose you've already shorted at this strike at 65 rupees and you wanted to keep a stop loss at 70 rupees. So what you do is, after you placed an entry, you simply place a stop loss order. You click on buy and you select the settings and select stop loss orders and click on continue. And now what you do is, you set the limit price and trigger price. So what happens is, I want to keep a stop loss around 70 rupees, right? So I'll keep a limit price which should be greater than this SL trigger. So I have shorted at 65, I'm keeping a stop loss at 70, and now what I'll do is, I'll give a buffer now. So I'm placing a stop loss limit means 70 rupees is the stop loss. So what I'll do is, I'll try to enter some 10 rupees buffer here. So the ideal point is, keep 10% of your overall stop loss level. My stop loss level is 70 rupees. So 70 rupees, 10% is 7 rupees. So what I'll do is, I'll give a limit price at 77. So this way, when stop loss is hit at 70, if market suddenly moves 71 or 72, you don't need to worry because you have given a 10% buffer. So my stop loss is 70 and the buffer is 77 limit price. So between this level, as long as market is moving, my order will get executed. So this way, instead of just giving both the price at 70 and 70, which means that you are giving no rooms for markets to move against you. So when I'm giving 70 rupees as stop loss, if you just give 70 exactly or 70.5, the overall buffer is very minimal. But when I keep a 10% buffer between stop loss, trigger order and limit price, then I give enough time for the markets to give me the exit criteria. So this way, when you are using stop loss, give 10% of your trigger price in the limit price so that it gets executed immediately. You don't need the stop loss jump will not happen very significantly. This way, you will not try to exit at the right time. So what are the things that you need to follow when you experience a stop loss jump? So you are an option seller, you have shorted it and now you have kept a stop loss and that stop loss is not filled and market suddenly moved up. So what are the things that you need to do is, you need to observe two things. First, whether it is a false jump or a true jump, which means that you check the actual underlying. So many times when you're an option trader, what happens is, on the underlying basis, market might not move up or move down. There won't be any much movement. But on the strike which you're trading, you will see a sudden move up and then no, it will come back to where it started. So these are called false spikes. So what happens is, whenever no, there are certain large number of orders placed in those option strikes, market makers try to move and hit your stop loss and come back to the same point. So these kind of spikes, you can escape from it. What happens is, when you keep a stop loss, definitely it is going to get hit. But when you keep a stop loss based on underlying, say suppose what happens is, I am not trying to enter into the markets around, no, say suppose the same scenario we take a consider for an example, 22,400 put option we have shorted since market is moving up, right? Now I have kept a stop loss, and not only when the market, the underlying moves down some 50 points from the peak, I'm going to exit if this is my exit criteria. Now what I'll observe is, I'll check my 22,400 call option, and also I'll check what is my underlying. So now if the 22,400 put option which I've shorted, if it starts moving up, then I'll consider okay, it's a true movement. And also I'll compare that with the underlying. If the underlying doesn't move down, but if the strike price which I've shorted, if it starts moving up, then that could be a false movement that can come back to its previous levels at any point of time. So always check your underlying with respect to whatever the instrument that you're trading with respect to the strike which you have shorted. So only when the underlying makes a good move, then it means that is a true move. So definitely you need to exit from your positions. If the underlying does not move, then you can wait for the positions to come back to your previous levels, because most of the time that will happen. So the true moves and false moves, you have to differentiate between your underlying with respect to your actual strike price. So how do you execute large number of orders? See, with respect to orders at a time, there are certain quantities where beyond which you will not be able to place a trade. So each and every instrument will have certain quantity freeze limit. For an example, with respect to Bank Nifty, beyond 900 quantity you can't place. And with respect to Nifty, beyond 1800 quantity you can't place at once. So whenever you are trying to buy any specific strike, say suppose I'm trying to buy this strike, then if I enter a quantity which is say suppose 1800, then it's fine. But if I enter 1850, then it means that I would not be able to execute this orders at once, because as per NSA exchange, you cannot place more than the freeze quantity at once. So you have to iceberg your orders. You have to place it, slice it, and then place it. Say suppose if I wanted to execute 4,000 quantity with respect to any kind of options, then I cannot place all at once. So you have to slice it and then send it to the exchange so that the order gets processed. So the best way to do it is always do it in staggered manner. So if I'm going to place the orders now, okay, I wanted to enter almost 4,000 quantity now. What I can do is I can put 1,800 quantity first, wait for 5 seconds, and then place an additional 1,800 quantity again, so that you are giving enough room, because when you place large quantity all at once, then there might be a higher impact cost. By waiting 5 seconds between each and every slicing orders, you are reducing the overall impact cost. So whenever you are trading with large quantities, always follow this mechanism. So coming to the last point, what are the things that you need to follow when you're trading in a volatile market conditions? See, first thing is you have to observe, is there any specific event that are going to happen when you're trading with respect to option selling? Because see, whenever there is a big event, maybe the RBI event, an election, or it could be anything with respect to global markets, so or any specific bigger events which has certain uncertainty. So when these kind of economic events or geopolitical events that was supposed to happen, maybe 1 week down the line or 1 month down the line or few days down the line, what happens is the amount of premium with respect to options might increase, and that can give you exorbitant movements. So when you're an option trader, no matter what, even these kinds of events are due, your stop loss might get hit because of these volatile movements. So first thing is observe if there are any events that are scheduled in few days, in coming weeks or coming days. If that is the case, then reduce your quantity. You cannot escape from volatility, but you can reduce the damage only through position sizing. So if you are, say suppose if you are trading with 100 lots, then reduce it to one third or 1 second of it. So probably you can trade with 50 lots or you can trade with 30 lots. And once the event is over, you can get back to your same position sizing. So these kind of volatile movements, whenever it happens, the best way that can help is whether we are able to survive that move or not. So with respect to options trading, it is all about survival. So the only way to survive in the markets is to keep your risk intact, keep your position size intact, so that the one move is not going to wipe you out. And the second thing is, no matter what, always use a hedged leg with respect to your option selling systems. So if you are shorting a specific strike, and try to keep an OTM options one leg or two legs above it, so that your overall risk is capped. So no matter where the market is moving, your risk is always capped. You know how much you're going to lose in that specific trade. When in case the stop loss is jumping on, whenever these kind of scenarios happens, you don't need to worry, because the edge is there to protect you. So keep these things in mind when you are trading with respect to volatile markets. So there is no specific strategy that can help you to survive the volatile markets. The only thing that is going to help you to survive the volatile markets is the ideal number of lots that you are going to trade, the ideal number of risk per trade that you are going to put in that trade. Because no matter what, when the market is extremely volatile, it can move at any levels. So always see if there are any events due, and if there are any events due, reduce your overall quantity, and then once the event is over, then you can get back to your old position sizing. Because when there is an event, definitely the IVs can shoot up, the VIX can shoot up, that anything can happen. So the risk reward ratios will not be in our favor when the market is extremely volatile. So best way to survive those periods is to reduce the overall position quantity and then trade with it. So these are the things that I want to explain in this video. So I hope you found this video really helpful, and see you guys next week with another video.